for this video, I'd like to walk you through the transaction analysis for the Softbyte company that is included in your accounting textbook. So we will be using the tabular analysis that I provided to you in class, and you can see at the top here we have the basic accounting equation: assets equals liabilities plus owner's equity. And then as part of assets, we've broken it down into different types of assets so that we are able to record our transactions more easily. We also have under liabilities a specific type of liability called accounts payable, and under owner's equity we have the four components of owner's equity: the owner's capital, which increases owner's equity; revenues, which also increase owner's equity; drawings, which decrease owner's equity because the owner is taking money out of the business; and expenses, which also decrease owner's equity because they are cost of doing business. Remember, revenue minus expenses is the owner's profit or loss, and in a sole proprietor, which is the type of company we're working with, profit and loss all goes to the owner. That's why they all impact owner's equity. So looking at the first transaction, we see that we have an investment by the owner. So Ray Neal decides to open a computer programming service, which he names Softbyte, and then on September 1st, he invests $15,000 cash in the business. Now remember, we are looking at these transactions from the perspective of the company, not from the perspective of the owner. Therefore, we know that the cash of the business is increasing by $15,000 when the owner invests in the business. So we return to the tabular analysis, and under cash, we increase cash by $15,000. That means that the asset cash of the company is going up. Now we want to ask ourselves, well, what else is happening in this transaction? Because with accounting, there are always two sides to the story. We should impact at least two of these columns, maybe more. So since the owner is investing cash in the business, we may be thinking about owner's capital, and that is correct. The owner's investment increases the owner's capital in the business. Now you may ask, well, isn't this perhaps revenue or something else? No, revenue comes from when we actually provide services or we provide goods to customers, whereas an investment by the owner is going to actually increase the owner's capital of the business. Now let's think about some of these other columns like accounts receivable, supplies, equipment. None of those are going to be involved in this transaction. The reason being that the asset that's involved is cash. Also, we don't have any liabilities. There's nothing for the company to pay. There's no expense here, and certainly the owner has not withdrawn any money. So as a result, we have 15,000 on the asset side and 15,000 on owner's equity, and therefore the equation balances, which is very important. Remember, we always want the equation to balance in dollar amount and in sign, either plus or minus, at the end of recording each transaction. Moving along to the second transaction, we see that we have the purchase of equipment for cash. So on September 1st, 2014, Softbyte purchases computer equipment for $7,000 cash. So there are some key words here: purchases equipment for cash. So again, picture yourself at the company as the accountant. You are seeing those Best Buy boxes coming in with all the computers. That means the company has more equipment, and you have also had to pay cash for that. So when we pay cash, our cash goes down. So cash is going to decrease by $7,000. And then since we purchased additional equipment, we will increase equipment by $7,000 as well. So a decrease in cash because we paid cash for the equipment, and an increase in the computer equipment because we bought the asset equipment. Now you may be asking yourself, but isn't this an expense? Why didn't we record the equipment under expenses? Remember, an asset is something that we own where we will get future benefits, either in terms of use or in terms of cash cash flow. We do not record the equipment as an expense because the equipment is going to be used in the future and it will give us benefits. Therefore, it is an asset. There is no liability here because we've already paid cash for this asset. This transaction doesn't impact our owner's equity at all. It doesn't come out of the owner's capital because remember, we are paying cash. The owner is not withdrawing money from the business. All these transactions are done from the perspective of the company. Now, let me ask you, are we in balance? Well, we have plus 7,000 minus 7,000, which equals 0. So we have 0 on the asset side and 0 on the liabilities and owner's equity side. Therefore, we are in balance and we can, in fact, balance on 0. The third transaction has us purchasing supplies on credit. On September 5th, 2014, Softbyte purchases $1,600 on account, right, from Acme Company, computer paper, and other supplies expected to last several months. So again, we're the accountants at the company. So we picture now all the supplies coming in from Acme. So we have more supplies and we did not pay cash. So now the question is, where does the other side of this transaction go? So for number 3, we are going to increase our supplies by $1,600 because we have purchased those supplies. We cannot decrease cash because we haven't paid cash for this transaction. But what did we see? We purchased on account, right? So when we purchase on account, we will have to make a payment in the future because we owe money. And when we buy on account or purchase on account, that tells us that we will have a liability because we have a debt that we will have to settle in the future. So when we go to our liabilities column, we see that we have the liability accounts payable, which is the one that applies to this transaction. Now, many of us think about liabilities as being bad, so we want to make the number negative. But the reality is that when we purchase on account, our balance that we owe actually increases. Therefore, we will put plus 1,600 on our transaction. So the balance on the liability goes up. Think about that for a minute. If you receive your credit card statement, for instance, the balance on the credit card statement is not negative, it's positive because it's showing you that you have a balance owing. Similarly, for this company, when they purchase on account, the balance in their liabilities is going to go up to show that they owe more money. Now let's ask, should there be any other columns involved? Well, again, just like with the computer equipment, we will not expense our supplies. The reason being that supplies, again, are an asset that we will use in the future. An expense is a cost that has already happened, and since the supplies are still going to be used, they will stay in the asset column. There are no other columns involved either. Therefore, we can see that our assets at 1,600 positive equal our liabilities at 1,600 positive, so the equation is in balance. Looking at transaction number 4, we see that we have services provided for cash. So here, Ray Neal is beginning to provide services to his customers and is going to be making some money. And so it says that on September 10th, 2014, Softbyte receives $1,200 cash. So receiving cash from the perspective of the company means that the cash account is going to go up. They are receiving it from customers for services provided. These two words are very important because what this means is that we have earned revenue. Services provided means that revenue was earned. So as a result, we will also have an increase to our revenue, which will increase our owner's equity. So again, receiving cash means that cash goes up by $1,200. And as a result of providing the services, our revenues also increase by $1,200. So, as a result of this transaction, the company has $1,200 more in its bank account, and it can also show that it has earned $1,200 of revenue. Remember, an increase in revenue will increase owner's equity because revenue positively impacts owner's equity. Is there any other column that we should involve here? Well, since the customer's paid already, there's no receivable and none of the other columns are really applicable. And when we look at our transaction, we see that we have plus 1200 in cash and plus 1200 in revenue, which means that we are in balance. So let's move on to transaction number 5. Purchases of advertising on credit. So purchase on credit is the same like saying purchase on account. When we purchase on account or on credit, it means that we are not paying in that moment and we are going to be paying in the future. So on September 15th, 2014, Softbyte receives a bill. Now we all know what that means. When we receive a bill, it means that we owe money. So they receive a bill for $250 from the Daily News for advertising, but postpones payment until a later date. To postpone payment means that we are not making payment today, we will go and make payment sometime in the future, again telling us that there's going to be some type of liability because the payment has not currently been made. So let's think about this. The company had advertising that they have not yet paid for. Remember we said that there's always at least two sides to the story in accounting, so there should be at least two of these columns involved. They owe some money and they also have advertising. Now let me just end the suspense and tell you that advertising is an expense for the company. Again, advertising is an expense. It's a cost of doing business. So this transaction is going to impact our expenses and it will also impact our liabilities because we still owe the money. So let's go ahead and look at the transaction analysis to see how we account for this transaction. Since we received a bill and we haven't paid, we will owe more money. Remember we said that when we purchase on account or purchase on credit, our liability balance increases. Therefore, we have to show plus 250 in the liabilities column. We did not pay cash, so we cannot use our cash column for this transaction. Also, we said that we have a liability relating to an expense, which is advertising. So the advertising expense is going up, but when expenses go up, owner's equity goes down. So we will put minus 250 in the expenses column. The negative is not because expenses are going down. The negative is shown because when we have an increase in expenses, we will result in a decrease to owner's equity. Again, when there is an increase in expenses, in this case in the form of advertising expense, we will also have a decrease to owner's equity because the owner is suffering the cost of doing business in the form of advertising expense. Now, looking at this transaction, we see that we have a positive 250 under liabilities and a negative 250 under expenses, which together equal 0. And on our asset side, we have no impact for this transaction, which means that we still balance since 0 equals 0. So this transaction is similar to the one in number 2, where we only have activity on one side of the equation. Again, we had an advertising expense that causes our owner's equity to go down, and because we didn't pay in cash immediately, we also have a liability in the form of accounts payable. Looking at transaction number 6, we see that services have been provided. Again, when you see the word services provided, you immediately want to be thinking that revenue is increasing. Okay, so services provided, automatically we should be recognizing revenue. But these services, some of the services were paid for in cash and some were on credit. Now, when services are provided on credit, that means that our customers have received the service, but they have not yet given us the cash for the service, which means that we will be receiving the cash from them in the future. Again, our customers have the service, but they have not yet paid for the service, which means that we will be receiving the cash in the future, which tells us that accounts receivable will be involved. When we provide services to customers for credit or on account, we will have an accounts receivable balance. On September 16, 2014, Softbyte provides 3,500 of programming services for customers. So we can stop there and say to ourselves, oh, we know when services are provided, revenue has to increase. So going back to the transaction analysis, we can immediately go to the revenue column and say that when there is an increase in revenue, there is also an increase in owner's equity. So we have plus 3,500 under our revenue column to show the services that have been provided. Continuing reading on here, we see that the company receives cash of 1,500. Now, let me say here that cash is a fact. If you see that cash was received or paid, you have to impact the cash column. So since we receive cash of 1,500, we will have to increase our cash by 1,500. Now, looking at this transaction, we see that there's a problem. We have plus 3,500 on the owner's equity side of things, but only plus 1,500 under assets, which means that we are not yet in balance. So let's read further and see if we can find where the rest of the transaction is hidden. It says here that the company bills the balance of this transaction on account. Now you may be thinking, oh, there's a bill, so the company might have something to pay. But remember, we could receive a bill like we did in transaction number 5, at which point the company does have a bill to pay, but the company could also bill its customers, which means that the company will receive money from the customers in the future. So what happened here was that the company provided services of 3,500. The customer decided to pay 1,500 immediately in cash, and they will pay the rest in the future. So the company will be receiving $2,000 from customers in the future. So if you had to go to, let's say, Macy's, and you decide to buy a coat, and the coat costs $300, you might decide to pay $100 in cash and put $200 on your Macy's card. For Macy's, they've received $100 cash, and the other 200 they will receive from you in the future, which represents accounts receivable to them. The same year with Softbyte, the 2,000 is going to be shown as an increase to accounts receivable. Remember, accounts receivable is an asset which shows any amounts that are to be received from customers in the future. Now looking at this transaction, we can see that on the asset side, when we add these two together, we have plus 3,500, and on the liabilities and owner's equity side, we also have plus 3,500, which means that we are in balance. And congratulations to you, this is your first compound entry, meaning you had more than 2 columns that you used, and you can see that we actually have 3 balances here, but in the end we still do balance, and our equation is in order. Moving on to transaction number 7, we see that there's a payment of expenses. So on September 18th, 2014, Softbyte pays the following expenses in cash. So there's a cash payment. Remember what I said, cash is a fact. If cash gets paid, then we will have to decrease our cash account. It's just like you paying your rent or something in cash, you will have less cash in the bank. So they pay for store rent, $600. Not sure where they're renting. It can't be New York if the rent is so low, right? But the store rent is 600, salaries of employees 900, and utilities of 200. So these amounts together are going to add up to $1,700. So Softbyte must have made a payment of $1,700 in cash for these various expenses. So let's go ahead and record this transaction. As we said, they made a cash payment, so cash goes down by 1,700, and then we also have the expenses. Remember that an increase in our expenses causes a decrease to our owner's equity. Again, an increase in our expenses causes a decrease to our owner's equity because the owner has to bear the cost of doing business. So our various expenses we'll put in one by one into the expenses column. You'll find out later that we will need to know what these expenses are when we build the financial statements. So just looking again, rent is 600, salaries 900, and utilities of 200. So minus 600 rent, minus 900 salaries, and minus 200 for our utilities. Those all add up to 1700. Again, remember that the negative is not because expenses are going down or because they are being paid. It is because the fact that we have more expenses actually decreases our owner's equity. So this 1700 balances with the negative 1700 in our cash account. So continuing on to transaction number 8, we see that there's a payment of the accounts payable. So basically the company had a debt owing in the form of accounts payable, and they have decided to pay this amount or some portion of this amount. So it says here that on September 21st, 2014, Softbyte pays its $250 daily news bill from transaction 5 in cash. Now, you have to remember that the company is doing its business all the time. So sometimes a transaction in, like this one, for instance, transaction number 8, is relating to a previous transaction. So we are referring to transaction 5 because in transaction 5, if we go back and look, we see that we created a liability balance because Softbyte owed the money. Now they've decided to pay the money. Since we pay cash, remember cash is a fact, when cash gets paid, cash goes down by $250. Now remember, you have to have two sides, at least two sides to the story. So where does the other side of this go? Softbyte is paying its bill, which means that somehow it needs to reflect that it doesn't owe that money anymore. So when we go and look in the accounts payable column, we see that they are still reflecting that they owe that amount. So we will have to show that the amount has been paid by having a negative $250 amount in this column, so that you can see that these two amounts are going to zero out. So looking at transaction number 8, we have minus 250 in the cash column and minus 250 in accounts payable. Now let me ask you this, what about expenses? Why don't we record another expense since we are paying cash? Well, thinking about it, we see that we already have a minus 250 in the expense column. So if we go and record another minus 250, we will end up double counting this expense. So the rule that this tells us is that the paying off of the liability doesn't create another expense. We are simply decreasing our balance. Think of it this way. If you pay your credit card bill, maybe you bought a pair of shoes on the credit card. When you pay your credit card bill, the credit card bill goes down to zero. You don't end up owing more money or receiving another pair of shoes in the mail just because you paid your bill. I know some of you probably wish that you would, but you're not going to get another pair of shoes for paying your bill. Similarly, Softbyte won't have another expense just by virtue of paying its existing bill. Looking at transaction number 9, we see that there's a receipt of cash on account. Receipt is just receiving cash, so already we know that cash is probably going to go up. So let's read. On September 24th, 2014, Softbyte received $600 in cash from customers who had been billed for services in transaction 6. So here again, this principle comes to the fore that I was speaking about previously, in that we are referring back to transaction 6. So let's think about what happened in transaction 6. So we see here that in transaction 6, Softbyte performed $3,500 worth of services, some of which was paid for in cash and the other is still to be received from customers. And what it's saying now in transaction number 9 is that some of this money is being received from our customers. I'm sure the owner, Ray Neal, is very excited about that because he would want to have the cash in hand. So they receive $600 in cash. That means that cash goes up. So we say plus $600 under cash. And now the question is, where does the other amount go? Is this revenue, you may be asking? Surely this is revenue since we're getting money from our customers. And I'll tell you, no. We do not have additional revenue. Remember, we already recorded the revenue related to this transaction, so we cannot record an additional $600 worth of revenue since we didn't perform more services. But what should happen? Think about it. The customer previously had a $2,000 balance. Now they are paying some amount. So we need to show in the customer's account that their balance is going down by $600 because we received $600 from them, right? So in the end, if they had to ask us for their balance today, we would say, oh, customer, you owe $1,400. So again, when we receive cash from a customer for an account that they have with us, we do not record additional revenue. Instead, we decrease the customer's balance to show that they have made the payment. Now let's talk about whether we balance. Again, we see that we've increased cash and decreased accounts receivable, which means that we zero out over here, right? And we have a zero balance on the other side. Remember, this transaction does not affect your revenue, so you are zeroed out on both sides, which means that you do balance. For our last transaction, we see that there's a withdrawal of cash by the owner. Remember, this is not fraudulent or anything weird or sketchy. The owner is simply taking out money because the owner doesn't necessarily receive a salary. So from time to time, they will take out withdrawals to be able to cover their personal expenses. So on September 27th, 2014, Ray Neal withdraws $1,300 in cash from the business for his personal use. Now remember, we look at everything from the perspective of the company, and what we find is that the company's cash is going to decrease as a result of Ray Neal taking money out of the company. So we have to have minus 1,300 under cash. And where does the other side go? Well, you might remember that owner's drawings is one of the things that impact owner's equity. Owner's drawings is the account or the column that we will use to reflect the amounts that are taken out by the owner. Now, owner's drawings is increasing, but when there's an increase in owner's drawings, it actually results in a decrease to owner's equity. Think of it this way. If you go to the ATM and you withdraw $20 out of your bank account is going to go down. So the more you withdraw, so in other words, the higher your drawings, the lower your bank account. So if we think of owner's equity as the bank account in this case, the 1,300 of drawings is going to decrease the owner's equity balance. That's why we show a minus sign in front of the 1,300 of drawings. So now you have been able to complete all 10 transactions, and the next step would be to add and subtract all these numbers to be able to come up with the final balance for each of these columns. So you can go ahead and do that, and then we will meet again next time and be able to take this one step further when we work on the financial statements.